Welcome to our deep dive into the world of investing. Today we're going beyond the usual buy low, sell high advice. We're going to be exploring how to navigate change and uncertainty and how to do it in a way that actually benefits you. So imagine this economic moving walkway that you've been riding. You hadn't even realized it. Has it been carrying you along? That's the interesting question. That's the questions posed by Howard Marks. He is a legendary investor and co-founder of Oak Tree Capital. We're diving into a fascinating global money talk interview with Marks today, and he's spent an incredible 54 years in finance. He's witnessed firsthand how markets shift. Our mission today is to unpack Marks' concept of a sea change in investing and what it means for you today. We'll uncover specific anecdotes and advice from the interview so you can make smarter decisions for your own portfolio. So what exactly is a sea change?
So it's not just some market fluctuation or anything like that. Marx is talking about a fundamental shift in the entire investment environment, something that reshapes the landscape for years or even decades. He points to three major sea changes he's seen in his career, and the biggest one for many investors has been the shift from high interest rates to the era of ultra-low rates that we've experienced recently.
Yeah, this is where his story about framing interest rate bills really hits home. Back in 1980, he framed a loan statement with a 22.25% interest rate, believing he'd never see rates that high again. Fast forward to 2020, he gets a loan at just 2.25%, and his interviewer is joking that he should frame that bill too. It really highlights how drastically things have changed and why understanding these shifts is so crucial. Okay, but how does this connect to the moving walkway idea? And why should we even care?
Well, for years, declining or low interest rates created this moving walkway that made investing feel easier than ever, boosting asset values, and maybe even leading to some complacency among investors. But what's fascinating here is, were you benefiting from this walkway without realizing it? And what happens if it slows down or even starts moving in reverse?
That's a bit unsettling. Are there signs that this easy ride might be ending?
Marx certainly thinks so. It points to several key factors, including rising inflation, which we've all been feeling, and the Federal Reserve's response of raising interest rates to combat that inflation. There's also the looming possibility of a recession, which adds another layer of complexity to the situation.
So it's not just about the stock market going up or down. It's about understanding the underlying forces that drive those changes and how they impact your investments over time. This is where Mark's idea of second-level thinking comes in, right? He dives deep into this in his book, The Most Important Thing. It seems like second-level thinking is about looking beyond the surface to truly grasp what's happening.
Exactly. It's about going beyond simply asking what's happening and digging deeper to understand why. Think back to the Nifty 50 stocks in the 1970s. Back then, everyone thought those companies were guaranteed winners. They were the hot stocks, the ones everyone wanted to own.
So what happened? Did they all become success stories?
Well, they actually ended up crashing and burning. Why? Because most investors failed to apply second-level thinking. They didn't look beyond the hype to consider what could go wrong, what risks were hidden beneath the surface. They followed the crowd instead of thinking for themselves.
That's where independent thinking becomes so important, right? Not just following the herd, but doing your own research and developing your own investment philosophy.
Exactly. Mark puts it brilliantly when he says, "Don't follow the crowd, always think contrarian." It's a powerful reminder that in investing, just like in life, it pays to challenge assumptions and think differently.
Marx has a lot more to say about second-level thinking and how to apply it, so stay tuned for part 2 of our deep dive. We'll get into more specific examples and actionable advice. We'll be right back after a short break. Welcome back to our deep dive with Howard Marks. We've laid the groundwork, exploring the concept of sea changes and the need for second-level thinking. Now let's get tactical. How can we apply these ideas to make smarter investment decisions, especially as the economic moving walkway we discussed might be shifting?
Well, one of Mark's key pieces of advice is to rethink our approach to debt. In a low interest rate environment, taking on debt might have seemed less risky, even advantageous at times. But as interest rates rise, the cost of borrowing increases, and that changes the dynamics significantly.
So should we be avoiding debt entirely now?
Not necessarily. It's about being more strategic, understanding how debt fits into your overall financial picture. For instance, if you're considering a big purchase like a house or a car, locking in a lower interest rate sooner rather than later could be a smart move. On the other hand, managing existing debt becomes crucial in this environment.
What would you suggest for managing existing debt? Many people are probably feeling the pinch as rates rise.
Prioritizing high-interest debt is key. Focus on paying down credit card balances or personal loans first, as those tend to carry the heaviest interest burdens. It's also worth exploring. Whether consolidating or refinancing existing loans can help you secure a lower interest rate. potentially saving you money in the long run.
So it's all about being mindful of those interest rates and making sure debt works for you, not against you. This ties in with the idea of risk management, another crucial aspect of investing, especially when things feel uncertain.
Absolutely. And Marx emphasizes diversification as a fundamental principle of risk management. As the saying goes, don't put all your eggs in one basket. Spread your investments across different asset classes: stocks, bonds, real estate, even alternative investments like commodities or precious metals.
Why is diversification so important, especially now?
Diversifying helps create a buffer against market volatility. If one asset class takes a hit, others might perform better, cushioning the blow to your overall portfolio. Think of it as building shock absorbers for your investments. And remember, diversification goes beyond what you invest in. It also involves when you invest.
That's an interesting point. How does timing play into diversification?
Well, a strategy like dollar cost averaging can be really effective. Instead of investing a large lump sum all at once, you invest smaller amounts at regular intervals, regardless of whether the market is up or down.
So if the market dips, you're buying at a lower price. And if it rises, you're still benefiting from the overall upward trend. This sounds like a way to take advantage of market fluctuations, rather than being scared by them.
Exactly. Dollar cost averaging smooths out the investment journey and can reduce the risk of making a big investment at the wrong time. It aligns with Marx's idea of second-level thinking, focusing on the long term and not letting short-term market noise dictate your decisions.
This makes a lot of sense. We're not just reacting emotionally to market ups and downs, but rather taking a more calculated approach. And speaking of second-level thinking, Marx also talks a lot about identifying opportunities, especially in times of change.
That's right. Change often creates opportunities that others might overlook. And this is where independent research and critical thinking becomes so crucial. Marx encourages investors to dig deeper, look beyond the headlines, and identify areas where the market might be mispricing assets.
Can you give us some examples of how this might play out in today's market?
Sure, take the current environment of rising interest rates. While it might pose challenges, it also presents potential opportunities. For example, as we discussed earlier, certain debt instruments might become more attractive as yields rise. Or consider sectors that are currently out of favor, but have solid long-term growth potential. Those could offer opportunities for contrarian investors, willing to look beyond the immediate negativity.
It sounds like it's about being a bit of a detective, looking for value where others might be missing it.
Exactly. Remember, the crowd isn't always right. Sometimes the best opportunities are found by going against the grain, by thinking independently, and forming your own conclusions based on solid research.
This is all great advice, but I have to admit, it can feel a bit overwhelming at times. There's so much information out there, so many factors to consider. How can we stay focused and avoid getting bogged down by information overload?
That's a great question, and it's something many investors struggle with. One of the most effective ways to navigate the information deluge is to develop your own investment philosophy.
What exactly do you mean by an investment philosophy? Is that something I need to write down and frame?
It doesn't have to be that formal. It's more about clearly defining your goals, your risk tolerance, and your time horizon. What are you hoping to achieve with your investments? How much risk are you comfortable taking on? How long do you plan to invest your money?
So it's like having a personal roadmap for your investments, helping you stay focused and make decisions that align with your individual circumstances and aspirations.
Precisely. It's about understanding your own needs and priorities, which then allows you to filter out the noise and focus on the information that's most relevant to you. It prevents you from getting swayed by the latest fads or market hype and keeps you grounded in what truly matters for your financial well-being.
This is starting to make a lot of sense. It's not just about blindly following rules or formulas, but about having a framework for making informed decisions based on your own unique circumstances and goals.
You got it. And remember, investing is a journey, not a destination. There will be ups and downs along the way. Market fluctuations are inevitable. The key is to stay informed, stay disciplined, and adjust your course as needed, always keeping your long-term goals in sight.
Welcome back to our deep dive into investing with insights from Howard Marks. We've covered a lot of ground, from understanding sea changes and the economic moving walkway to embracing second-level thinking and crafting your own investment philosophy. Now let's bring it all together and explore how you can put these concepts into action. We've talked about how crucial second-level thinking is, but it can still feel a bit abstract. Can you give us some concrete examples of how this plays out in making real-world investment decisions?
Absolutely. Imagine you're seeing a surge of excitement around a particular sector, let's say renewable energy. Everyone's talking about it, money's pouring in, and valuations are skyrocketing. It's tempting to just jump on the bandwagon, right?
It definitely sounds familiar. We've seen it happen with tech stocks, real estate, Even certain commodities, the fear of missing out can be pretty powerful.
That's exactly where second-level thinking comes in. Instead of just following the crowd, you pause and ask yourself, why is everyone so excited about this? What are the underlying assumptions driving this trend? And are those assumptions actually valid? You dig deeper, beyond the hype, to understand what's really going on.
So you're looking for potential cracks in the narrative, trying to figure out if the current price truly reflects the long-term potential, or if it's just a bubble waiting to burst.
Exactly. You might discover that the sector is indeed poised for growth, but that the current valuations are unsustainable. Or you might find that the market is overlooking certain risks or challenges that could derail the hype train.
For example, with renewable energy, maybe there are supply chain bottlenecks for crucial components, or regulatory hurdles that could slow down adoption, or even technological advancements that could make current solutions obsolete.
Precisely. By applying second-level thinking, you're not dismissing the potential of the sector, but you're taking a more informed approach. You're doing your own research, forming your own conclusions, and deciding whether to invest based on a deeper understanding of the risks and rewards.
This reminds me of Mark's emphasis on being a contrarian, not just blindly following the herd.
Right. Another example could be a company that's going through a tough period. Maybe they've missed earnings targets, or there's been some negative news, and the stock price is plummeting. Many investors might see this as a sign to sell, but a second-level thinker would approach it differently.
They wouldn't just panic and follow the crowd. They'd take a step back and try to understand what's really happening.
Exactly. They'd ask themselves, is this a temporary setback or a sign of deeper problems? Is the market overreacting? And what is the intrinsic value of this company, regardless of the current sentiment?
So they'd be looking for signs of a potential turnaround, or perhaps an opportunity to buy a valuable asset at a discounted price, but only after carefully considering the risks involved.
Exactly. They might analyze the company's financials, their management team, their competitive landscape, their long-term growth prospects, and based on that analysis, they might see an opportunity where others only see risk.
It's all about seeing the world differently, isn't it? Questioning assumptions, challenging the consensus, and thinking for yourself.
That's the essence of second-level thinking. And remember, it's not just about finding hidden gems or predicting market turns. It's also about understanding the broader economic and geopolitical landscape and how those forces might impact your investments.
Can you give an example of how this broader perspective plays a role?
Let's take inflation, for instance. Everyone's talking about it, worried about its impact. But a second-level thinker wouldn't just accept the headlines at face value. They'd dig deeper, asking questions like, what are the underlying causes of this inflation? Is it temporary or more structural? How will different asset classes be affected? And how will central banks respond?
So they're not just reacting emotionally to the news, but trying to understand the bigger picture and how it might create opportunities or risks for their portfolio.
Precisely. They might analyze historical inflation trends, study the current economic data, and consider how different assets have performed during past inflationary periods based on their analysis. They might decide to increase their exposure to assets that tend to do well during times of inflation, like commodities or real estate. Or they might focus on companies with strong pricing power, those that can pass on higher costs to consumers without hurting their sales.
This highlights how crucial it is to not only understand individual companies or sectors, but also to have a grasp of the macroeconomic forces at play and how they might influence the market as a whole.
Absolutely. And this process of second-level thinking, of questioning, analyzing, and adapting, is ongoing. The world is constantly changing, so you need to stay informed, stay curious, and be willing to adjust your approach as needed.
It's like a mental muscle that we need to constantly exercise to become better investors. This has been an incredibly insightful deep dive. I feel like I have a whole new set of tools and perspectives to apply to my own investment journey. Before we wrap up, any final words of wisdom from Howard Marks that we can leave our listeners with?
Well, Marx emphasizes the importance of staying humble, recognizing that we don't know everything, and being prepared to adapt as the world changes. He also stresses the importance of having a margin of safety in your investments. Don't overpay, don't overextend yourself, and don't chase risky bets just because everyone else is doing it.
So it's about being prudent, being disciplined, and being realistic about the risks involved. And ultimately, it's about aligning your investments with your own goals and values.
Well said. Investing isn't just about making money. It's about achieving your financial goals, securing your future, and living a life of freedom and abundance.
On that note, we'll leave you with a final thought-provoking question. Inspired by Howard Marks himself, how will you apply the principles of second-level thinking to your own investment journey? Think about it, explore it, and make it your own. Until next time, happy investing. 631016